following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, good afternoon, folks. Pleasure to be here today. If you have any questions, it's 877-927-6648. And we're going to start the show today with the VIX index, showing the first chart here into Tiger TV. We owe Basil Chapman a vote of thanks for bringing this to our attention many years ago, at least for me it was, because this thing does a good job of timing when the markets are going to turn. I mean, this thing went right up to the 786 the other day when it reached up into that 20 level. And, that's when the S&P was breaking down below 2,000. It could not get above the 786, and now we're having this pretty precipitous sell-off in the VIX and a rally in the stock market, which is pretty predictable about what this thing has done. So you have to really take a look at it. I wanted to mention one thing, and that is the Standard & Poor's Company. They do ratings, and they have been banned by the SEC for 1 year for making any ratings on corporate mortgage holding bonds. I saw that on Bloomberg today. They also have settled with the government, the U.S. government, for $1.5 billion because they downgraded the bonds from AAA to AA several years ago, if you remember. And evidently there was a lawsuit going on, and I guess they elected to pay the fine or whatever it was going to be to get out of it. So evidently the freedom of the speech is getting a little wavery over there in Washington, because usually they had the ability to say what they want because they're a rating agency. They should be able to rate them the way they see them, rightly or wrongly. But that's neither here nor there. The other thing that I wanted to mention that is extremely important, I'm sure other people here have told us that, we have the European Central Bank is meeting tomorrow, the ECB, that's equivalent to our Fed, and they're going to be discussing quantitative easing, and I don't know what's going to happen. There was supposedly a leak this morning that there was a leak on quantitative easing, and the euro immediately dropped 100 pips. Excuse me, it went up 100 pips and then dropped 100 pips in a matter of just a couple of hours. This was part of the reason why we had the sell-off in gold, I believe. But, these markets are very, very jittery, so you have to pay, pretty close attention to what's going on. Some firms are still shell-shocked about what happened with the Swiss franc on the 15th of January when they unpegged to the euro, but that's neither here nor there. That's out of the way now. And the Swiss is trading normally again, if you can put a quotation marks around normally. But I would recommend, if you trade foreign exchange, is to really be extremely careful into the report of the ECB, because they can do some crazy things. And with illiquidity in the market during that time, it's not worth the risk. Even if you're correct, it's not worth the risk. So just be patient, wait till it's over, and then you can take a look at it and see, what it does from that level. We've had a really strong rally here in gold, which we were pleased to see. We got up to the 61% retracement of the high we made back in July of 2014, when the market was up around 1385. We got up to 1308 last night. It was just a tad above that. So we want to watch this correction if we get it in the silver and gold, to take a look at what will happen from there. I want to spend just a second about the silver and gold from here, because it has a very unusual situation, because the silver is lagging badly. I mean, it should be trading above $9 an ounce. In fact, it is not there, and that's telling us that it's completely about 80 cents under where it should be with gold, and that's the real key to look at. Now, I'm going to post a chart here showing the silver with this head and shoulders pattern that we looked at, back in early January when we thought this move was getting ready, to go up quite a bit. And in fact, we got rather lucky on this one, and it in fact did do that. So we want to post this into Tiger TV and let you folks take a look at it. And you'll see that the ABCD measures to almost $19 an ounce in silver, and we're trading at $18.14. Gold, on the other hand, has made a 1.618 expansion of the AB swing, taking it up to near the 1311 area. Got to 1308 today. And if you'll notice this chart, you'll see the chart on silver has potential to be a shooting star today. And if you look at it in the gold market, it is even more pronounced. If we get a low close today in gold, it will be a very, very pronounced shooting star. And that is probably one of the most bearish patterns of all candlestick patterns. I happen to know Steve Neeson, and I've had dinner with him a few times, and he's always mentioned that that was the one that was the most bearish in his opinion. So we'll take a look at that here. But I want to draw this in to let you see it. And fact is, what I'll do is I'll do it a little bit differently. I want to circle this because it's so important to look at this pattern because of the you don't see it very often. It's just you didn't even see it back in the July area. Or back into March, either one of those. So either one of those is a very important time. But you'll notice if we close in the lower part of the range today, which will be anything under 1290 per ounce in gold, that will complete that candlestick pattern. And we're in a 13-day run. We started this back on January 5th, so we're in the 13th day now of this run, and that's usually what you get during that time. We hit the exact 1.618 expansion of the AB leg this morning. That came in to the exact tick at 1308.50, and so it's going to be really interesting to see if this is going to be a very significant pullback in gold, because we really want to be a buyer. It's certainly tipped its hand. It has a chance of going higher. What we'd like to see now is a 3 to 5 day correction in the gold market, pulling down maybe as much as $50 or $60 down to the old breakout level at 1240. That would be an ideal place, to look at gold, because you would be buying a 61% retracement of the range from the January low when we hit the $1,170 per ounce level. So that's what we're keeping an eye on the gold. The gold stocks have held up pretty well. There's a few of them that have had some bad news and have acted very poorly, but overall, gold stocks are still holding up okay. The only caveat here, as I mentioned before, is the fact that silver is really lagging so badly. You'd like to see silver, which is the poor man's gold, be stronger. That would be telling us that the public would be more coming into the market. But we're not seeing any of that with open interest or volume or anything of that nature. That still has not happened in the gold and silver market. So those are a couple things that we want to be watching at that point. But any close today below the 1290 level, anywhere in here between 1292 and 1290, would signal that this is a shooting star, and it would tell us that we're getting ready for a correction. However, if the shooting star fails, all bets are off, because this thing could really go a great deal higher. There's no question about that. It looks bullish, has looked bullish since $1,170 an ounce, but now that you're $120 higher, you're getting people starting to look at it, and that the risk here is a little higher than it was at $1,170 an ounce. So just keep in mind that gold has this chance, because on the long-term weekly, we've mentioned many times over these past few months, it did not look that bad. That 1150, 1170 area was a very, very strong support area. And as you remember, the silver price hit the exact price of within 2 cents of $14.10 per ounce. So it's got a chance. That's basically, what we're looking at. We've had the first question is about the Russell. And I'll bring that up here, show you the IWM here. We'll take a look at that. I'm pretty sure that we've made a pretty significant top here in the Russell on a long-term basis here. And you'll see that we've been in this expanding triangle ever since November. and all we've done is come down and tested the area. The Russell is far weaker than the Nasdaq, the S&P, or the Dow Jones. So that's telling us that this market is probably the one to sell if you get your sell signal, whatever you'd like to look at. I like to watch the retracements, and we could get up another $3 in the IWM without any trouble at all. And we'll notice if that's going to happen, then we'll keep an eye on it. Now, I've had another question about the price of Apple and what we see in that on a long-term basis. We will take a look at it here. We've had a pretty good sell-off since December 1st. The market came down and stopped just about almost, well, it hit the 61% retracement exactly twice, and now we're in the midst of a rally here. And there's a Gartley farming, and we have the news today of I believe today is Apple's earnings. I think I heard that this morning as I was listening to early calls on Bloomberg, and that we could, well, you got to take all bets off with Apple, because this thing can jump $10, $15, $20 because it's a cult stock. And believe me, if they're in the mood, they can boost this up, quite a bit, and we'll take a look at it. So here's what Apple is looking at. We've had a double bottom down here at the 105 level. That was a 61% retracement to the exact tick coming off of our lows on October the 6th. So this is still in a up move. There's no question about it. We'll see what the news is going to bring with the earnings today. But if we go below that 104 level, that's going to signal a move all the way down to 93, because that would complete or start a large ABCD pattern that would take you down to just under $99 a share. So it's going to be interesting what the earnings say, and believe me, they react very, very rapidly to this market when you see these things occur. Now we're going to have to switch and go across the pond to the old place in Dusseldorf, where all the Porsches are made in Stuttgart, I think. I want to bring up the DAX index. We have one of our favorite folks here at TFNN requesting a DAX tray, or a DAX. Let's try it again, Larry. Requesting a chart on the DAX, which is the German version of the S&P 500. This has been an extremely bullish stock and our index. It's been much more bullish than any of our indices because we have made new highs rapidly here, and we have certainly we've been, hold on a second, I've got to get the data refreshed. There we go. And you'll see that we are completing a butterfly pattern up in this area. We've been here now for 4 days. So we're going to see if this is it. Now you stay with me, folks. We've got some more to talk about this DAX when we come back. We've got the Dow pretty strong and gold selling off a bit, and crude oil up $1.50.
How would you feel if you had a powerful decision-making tool that has the ability to find high-probability trading opportunities across multiple time frames in equities, currencies, and futures? Search no more. Take advantage of the best trade with the TAS Profile Scanner. Trade with confidence and clarity while using the software that thousands of institutional traders rely on to help them make the best and most accurate decisions. Scan over 1,000 equities, currencies, and futures instruments for high-probability trading setups utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time, for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. Subscribers will also gain access to the December 9th workshop with John Logan. There's no obligation to pay anything. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, we're finishing up the DAX here. It's got a lot of resistance up here at the 10,354. We haven't quite taken out yesterday's high, but it's just a matter of time until we actually do that. So we'll see what this is going to happen with us. I did want to show you something. I know we got our favorite caller on the line, Mr. Z from Philly, but I know he'll give me a second here to bring this other chart up, because I want to show the folks the DAX. I happen to follow this quite a bit nowadays, and you'll notice that we made a beautiful butterfly pattern in the that's a 3-drive pattern in the DAX today. Right at the bottom, it was a beautiful retracement and everything. It was just as perfect as you could possibly get, and the market rallied 150 points, which is equivalent to about 300 Dow points. So it does have some really good formations within the Fibonacci sequence that you can see. In fact, it actually trades better than the S&P 500. It's not nearly as liquid, of course, but it does trade as well. This is what people across the country, across the globe trade when we're sleeping. They're trading the DAX, and believe me, it is really active and gives a really quite a few swings. Now, we got our caller coming in. Mr. Z, are you there?
Hey, Larry, thanks for taking the call. On that DAX, it's right at new highs right as we speak. Does that, in your mind, suggest one way or another whether the S&P or the Dow will likely go to new highs as well, or not?
Well, John, I've looked at these, for the last couple of years now, and they're actually totally different vehicles. You know, when the S&P was breaking down below 2,000 down to that 1980 level, the DAX was already moving higher. So you have to look at each one separately, in my opinion. That's what it looks like. But you know, these have held up extremely well. They stopped exactly at the 61% retracement numbers at 1972 in the S&P. So this is still going higher until we finally turn over. Now we're 1 day past the new moon, and you know, if the market's going to turn down, it's going to do within a day or two where we are right now. So I still think you have to give it tomorrow, but right now I don't see any reason to be a seller of the DAX in here. Tomorrow I would be if we get up to 10,350, because that's going to be the real key level, because at that point you won't have to risk more than 50 pips in there, or points in the DAX, and that would make it much easier to look at.
Larry, do I presume that's that level, that 10,350, is one of your fib expansion calculations?
It's a 1.27 expansion of the move over the last 4.5 weeks is what it is.
Gotcha.
Now, if we go through that, we can go to 10,500 without any trouble, which would be the 1.618 expansion. And believe me, you know, that's only a 150 pip difference, so it could very easily do that. That's the advantage of these numbers, is when they fail, you have to get out of the way, and you know, that's you just can't stand in front of it. That's for sure.
So the primary reason I called in to speak with you this morning, Larry, was on bonds. The bonds had made a high, I guess it was last Friday, up at the 151 and change mark, and then the counter-trend bounce, not the counter-trend, the bounce today and yesterday failed to clear over highs, in fact held Fibonacci resistance, and now we've gone and made new swing lows at the 149 level. I'm wondering, is there anything that you're looking at that suggests in bonds the possibility of a significant high as compared to just a trading high?
Oh, John, I am thinking of a lot more than significant high. This has a possibility of really being something big, and I don't know if it's going to be related to the ECB or anything like that. But first, I'll put in the bond chart, and then we'll take a look at it. We might not make it through the break, John, so if we don't, please stick with us, because I think that we've got a really important topic here that affects all of us. And I think if we look at this, you'll see that we made a butterfly top here on the daily going back from October. And if we look at this on the long-term weekly basis, you can see it even clearer, because on the long-term weekly basis, you'll see that is making a 3 drive to a top pattern, you know, going back to last July. It's actually a perfect ABCD up in this level, so that's what makes it interesting. However, what we have to cover after the break, and I know you'll stay with us, is the big market. You know, the bonds are big. You know, they're much, much larger than any of the markets that most people trade. But the big one is the notes, and we'll cover that afterwards. Will you stay with us, please?
Will do, Larry.
Okay, we'll be right back, folks, after these words.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and we have Mr. Z from Philadelphia on the line. John, are you still with us?
Still here, Larry.
Okay, we're going to take a look. I posted into Tiger TV the weekly chart for the Treasury notes, and as you can see, you know, the bonds went above the 786, whereas the Treasury notes were barely able to take out the September highs, and then, of course, you know, reversed lower with that shooting star type pattern, and now that 61% retracement is really very important. And these are 6 times the volume that we have in the notes are 6 times the volume in the bonds. So this is really significant, in my opinion. I don't know what's going to happen with the ECB, but John, you know, you've been around this business almost as long as I have, and you know, we're looking at negative interest rates in Germany, Japan, India, and now Switzerland. I mean, we've never seen this in the history of the world, at least the world we've lived in recently. What's your feeling on that? To me, I think it's just a, you know, a bogus thing.
Larry, first I'd like to make a correction. I know you were around. When I first met you back in 2007 and we spoke a bunch in 8, you remarked how you were there personally to see the Panic of 1837, and I just have to correct you. I was not there nearly close to that.
That's correct. I was in the Oval Office when Lincoln was there, though.
Yes. I, too, I'm wondering on the bond market, specifically that 30-year Treasury market. You have made mention that the T-bond futures contract surpassed the 786 retracement compared to that July 2012 top. What I find interesting, and frankly, Larry, I don't know if it's significant or not, but I posted in the Tiger's Den for those people there to look at the yield on that 30-year Treasury paper. And what's interesting is that particular interest rate made a low of 2.351% today, which is a new record low, meaning it has gone to a yield lower than that July 2012 bottom. So when we look at patterns, we see subtle differences, with the idea being that the yield has gone to new lows and now is popping back up. So I certainly pay attention for reversals, because at this point I would think any reversal is a candidate for a bottom in yields or a top in bonds.
I agree. And now what we've just described to our listeners is a flattening of the yield curve. And that's not very positive for stocks. That's one of the better indicators that stocks are going to go lower, is when you have a flattening of the yield curve. And that's what is occurring right now. I just find it hard to believe that Spanish bonds and I think it's Spanish bonds and one of the, maybe it's Portugal, one of the BRIC nations. Their bonds are yielding less than our AAA U.S. Treasuries. Of course, maybe they might have watched the State of the Union last night, and that explains it. But I don't know. It's just strange that the country that is the policeman to the world, can't get more people interested in our bonds, especially with higher yields.
Larry, one thing to make mention of on European sovereign debt yields, there is a vast difference in market structure in European sovereign debt compared to U.S. Treasury debt, and it's specifically this. The vast percentage, and I don't know if it's 90% or 80%, but it's big. The vast percentage of sovereign debt, be it Spanish 10-year sovereign debt, or Italian bonds or French bonds, the vast majority of those instruments are held by banks, by the big banks, which are, integrated with the central banks and the ECB. And so one can envision a scenario there, more so than here, in which an order is given, passed down from on top saying, thou shalt buy the sovereign debt and hold it in the bank balance sheets. So that may that difference between there and here is fact. Whether or not that explains why Spanish yields on 10-year paper are lower than 10-year paper here, of course I'm not sure, but I have a guess that would be part of the explanation anyway.
That makes it good, makes it interesting, because our Fed is taking just about both sides of the market here, with notes and mortgage-backed securities and things like that. So that's a real interesting thing to look at. Now, since I have you on the line here, you alerted us to a potential buy here in the soybean market, and I noticed that the November soybeans, which haven't been planted yet, they won't be planted until May, is very, very close to that 786 retracement that we talked about a week ago. So are you still, it looks good to me. It's a beautiful Gartley, and I'm ready to buy it. So I'm just waiting for it to get about another 7 or 8 cents lower, and I'll be looking to buy November beans.
Larry, I concur there. The reason I am interested in speculating on beans here. First, they're low price. Second, we've got the pattern. Third, because prices have come down to where they are, and because costs of farming have exploded the past 6 years, be it the cost of land, be it the cost of regulation, be it the cost of equipment, and not to mention the cost of seed. And mind you, the only two places these people get their seed from are DuPont and Monsanto. Actually, there's a third, but from some very big players who've got pricing power. You've got a situation now where at these low prices, under $10, close to $9, The farmer is literally in a situation, on average, where he's looking to have, at best, a break-even year. And as a former Tiger's Den participant and show host Ed Young always used to say, the cure for low prices is low prices. And that's why I'm interested here in the beans. And, of course, that gives no weight whatsoever to any threat of, potential bad weather come springtime or summer. So yes.
Okay, my friend, listen, thank you very much for calling in, John, and we'll have you on soon. Okay?
Larry, thanks so much.
You bet, buddy. Happy New Year to you. Okay, we got another caller from California. Brent, are you there?
I am, Larry. How are you today?
I'm good. How's the weather over there? Are you dry or wet?
It's unfortunately, I guess it's nice. It's dry, but it's not what we need at the moment. So. Okay. What can I do for you, my friend? We've talked about this one before, CLR. Mm-hmm. My question is, I know that the 1-to-1 AB equals CD is around 43. Correct. But what I was going to ask you, and I don't think it's a total stretch. I just wanted to run it by you. I was doing some numbers, and the 1.618 expansion of the AB leg would be 49. 382 retracement of the total, move down from that 80 to 30 is 49. Mm-hmm. There's a gap between 50 and 45, which is 49. I just wanted to see what you thought of. I know that's kind of a stretch, but it seems like a possibility. Oh, it is certainly a possibility. Now, if we go to just a little bit more conservative, which you're going to get when you talk to the old man here, we're going to have an ABCD forming since the December 15th low. You bought this, really nice on that pullback on January 5th, as I recall, and that measures up to 44. So you got about another 10%, about 8% to go. To get to that level. But, when you get to that level, you've made 40% on your money. You better open your wallet and put a few bucks inside of it, is what I would do, because that's a pretty good run, and it would equal that move we had in December. So I would either tighten your stop really closely as you get there, or take part of it off, or take all of it off and look for a pullback, because none of these things go straight up, with the exception of things like Apple and what else goes straight up anymore? Not many things have been going straight up. Straight down, we've got crude oil. But anyway, that's what I would do. I would say around 44 is I would look to, you got to be pleased with this. You've gone up, up 40%, Brent, in just, a really short period of time. You don't get those types of moves very often. Oh, no, absolutely. And that's kind of was my initial target. And that's why I will certainly take some money off the table, and if not all of it. But I'll probably keep some little portion of it. I'm using. I agree with that. There's nothing. That's a good idea, because those numbers, those 49, you're up another 10% from that level. So you can always keep a portion on, and use a trailing stop. And if it moves, go take somewhere between 75 and 50% off, and then let the rest of it run, is what I would do. Or if you wanted to roll the dice, tighten your stop, and see what the casino's going to give you. Yeah, it just seemed like there was some possibility of it. I know it's kind of a stretch, but it seemed like there was a chance, just because there's so many things at that level, the gap, and just all those other things coming together. So. Mm-hmm. All right. Well, thank you very much. Hey, thank you for calling in, my friend, and happy holidays to you, and Happy New Year. Same to you, Larry. Take care. Okay. Okay, folks, the next thing we're going to take a look at here, we've got a very bullish market, going right now, with the markets coming back pretty strong. I have to bring this to your attention here, and that is the utility index has made new highs. We're back. We've already taken the high out from Christmas. So this is, still going higher.
very, very bullish formation here. We could easily go up another 5% in the utility index without any trouble at all. Maybe it's related to interest rates. I don't know, but we do have that, the big AB CD forming up here at this level. We took out the highs of December, as I mentioned before. So whether that's going to be a double top or not, I'm not sure. But long term, this thing has the possibility of going, even a little bit higher. But I do want to show you on the long-term weekly chart of the Dow Jones Utility, because that's the one that has the clearest pattern of all. Going back 14 years, you'll see that it has a perfect 3 drive to a top pattern on the weekly basis. It is perfectly symmetrical from the high of 2001 to the high of 2007 to where we are right now, 7 years each, and it's completing a perfect ABCD at that time. So that's going to be very interesting to watch without any trouble at all, in my opinion. So there's one thing that I really probably shouldn't bring up, but I'm going to bring it up one more time anyway, and that is the chart on margin debt, because nothing has changed very much. We've broken all new records again, and whether this is going to be a time where none of this stuff counts anymore, but we're higher than we were in 2000, much higher than we were in 2007, and you've got to be careful up in here, folks. These are outlier events. Just look where we were back in 1958 to where we are now. Of course, they didn't have the volume. We didn't turn 5 million shares a day until 1965. January of 65, we turned 5 million shares in a day. The reason why I remember that, I was in San Luis Obispo, California, at the Walston & Company office, and the man who owned Walston & Company was named Ross Perot. And I was in the men's facility standing there, and he came right next to me, and I had no idea who the dude was until we went out and got to introduce him to him. They had a big buffet set up there because they had a hunch that the market was going to do 5,000 shares. But one of the investors, a doctor, a plastic surgeon in San Luis Obispo, had 100,000 shares of American South African, and he was selling that at that day, and it was really exciting when we saw it cross the board, and it's really it was really exciting times. And later on, I finally figured out who Ross Perot was, but he was a really nice fellow, typical Texan, and really a really nice guy. But I remember that was 5 million shares. I think in the first hour, I believe Intel does 5 million shares now, if I'm not mistaken. I know it's some ridiculous amount now, but in 1965, that's what we were doing. We had our first 5 million shares a day on the New York Stock Exchange, and the most expensive stock on the New York Stock Exchange was Superior Oil, which was selling for $1,200 a share. So those are just a few of the memories that I have of the market way back when, but we'll take a look at what these happen a little bit later. Now, I did mention about the margin debt because I think it's very, very important, and I also want to bring in the New York Stock Exchange Index again, because we're still having this same divergence. This might be the fourth one if we get it here in the next few days. We'll see, but we'll be right back after this message here. We've got the Dow is still strong, up almost 50 points, and gold is still hanging in there, down $1.70.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy. A set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Darrell Martin here on TFNN.
Okay, folks, I've got an announcement. I'm going to have a special guest. We've had him on before, Ed Carlson of the Seattle Technicians Group. Ed is a CMT member, quite well known in the business. He is a follower of the works of George Lindsay, who was one of the best analysts during the 50s and 60s and 70s and 80s. He died on the top of the market on August the 25th of 1987. Rumor has it he had a heart attack carrying all those bags of cash up in his brownstone in New York. I shouldn't make fun of that, but I was trying to make a joke, and it was not very funny. But anyway, Ed's going to be on tomorrow. He knows quite a bit of technical analysis besides the things with George Lindsay, but he does some wonderful timing things with Lindsay's work, and he'll have some great information for us. So be sure you tune in tomorrow. He'll be on at the half hour, and then in the following week, I'm hoping to have Arch Crawford on, and then I'm going to have Bob Miner from the Dynamic Traders, and then we're also going to have Mark Douglas on very soon because he's coming out with his new book, and that'll be interesting to talk to Mark. Mark happens to be one of my best friends, so that'll be interesting. Now, I did post the chart of platinum into the Tiger Den today because we've had a request. If you notice, one of the reasons why I became so bullish on the gold, back in November, December, is because platinum was also making a 61% retracement from the low in 2008, and so far it's had a pretty good rally of just about $100 an ounce. It's much less strong here. Let's put it this way: it's much weaker than gold. It hasn't even made the 382 level, whereas gold has already made the 61% retracement. But gold is more of a speculative metal, whereas platinum is more of an industrial metal. So whether this is related to the situation in Russia, I'm not sure, because I believe that the bulk of the platinum comes out of South Africa and Russia, as I recall. So it is weaker, but it did give an indication that these metals were making a really significant bottom, back in November when they hit some of these levels that were so very, very weak. I'd like to end the show today to talk about the ECB meeting that's coming up tomorrow. We're having some tremendous volatility in these things. We had a 200 pip move in the euro again today. Remember, folks, the euro has a 61% retracement on the long-term weekly charts at 113, so we're only 270 pips away from that, and we could be there within 30 seconds if something really crazy happens. So mark that on your charts. It's going to be a very interesting spot to hit because we have several numbers coming together there. I believe there are 3 patterns coming together around that 113, 112 level in the euro. We've been bearish this for a very long time, and from the 139 level, back in March, and it looks like we are going to go, even lower yet with the volatility that we're having. Regarding crude oil's got a chance in here. We haven't really done very much, but it looks like, you're going to be able to see what's going to do that. Okay, now tomorrow the ECB meeting is, I don't know a whole lot about it. In other words, that Draghi and his boys are meeting. Evidently, Merkel does not want to have anything to do with quantitative easing. But, all I know is it's going to be very illiquid and very volatile. So just be extremely careful and try not to have Forex positions on unless you can afford the risk. Because, after we saw what happened to the Swiss franc on January 15th, that was a $30,000 move, folks, and a lot of people can't take that kind of hit. So live every day in an attitude of gratitude, and may God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.